After a detailed assessment of the evolving macroeconomic conditions and the outlook, the MPC voted unanimously to keep the policy repo rate unchanged at 5.5%. Consequently, the STF rate remains at 5.25%, while the MSF rate and the bank rate remain at 5.75%. The MPC also decided to continue with a neutral stance.
Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is the special edition where we're going to be decoding all that the policy announcements have been. The Reserve Bank of India, the Monetary Policy Committee has now kept the repo rate unchanged. As you heard the governor also speaking at 5.5%. This is for the second consecutive time. As has been announced by the governor, the decision has been made unanimously by the MPC committee, which has also unanimously decided to maintain a neutral stance as well. Remember, the RBI's action also comes against the backdrop of US Federal Reserve alongside several other central banks in the world also cutting rates. Remember, the RBI governor has stated that the inflation number has remained above the target, while momentum in the domestic economy has also remained resilient. 5 key announcements that have been made are as far as the repo rate, and the stance has remained unchanged as I have marked out for you. The other aspect is that the RBI has lowered the inflation projection for FY26 now at 2.6%. vis-a-vis earlier of 3.1%. What we're also given to understand is that the RBI governor has further stated that the recent GST cuts will lead to reduction in the prices in the CPI basket. The real GDP growth forecast has also been revised upwards to 6.8% from the earlier estimate of 6.5%, indicating stronger than expected economic performance. And this comes at the backdrop of strong Q1 FY26 GDP growth number, which actually stood at an impressive 7.8% as well. Now let's actually go on to decoding what the statements mean, what these announcements mean, with 2 very special guests joining in on the program. We have with us Ms. Aditi Nayar, the Chief Economist of ICRA. Also joining in with us is Mr. Madan Sabnavis. He's the Chief Economist of Bank of Baroda and he joins in on the program with us as well. Warm welcome to both of you and thank you so much for taking the time out. Aditi, starting off with you, a dovish pause, as much as dovish as it was possible probably, and has it also opened up more space for policy further easing going forward in this year?
Thank you, Sakshi. Certainly a very dovish pause. We thought this was going to be a very close call between a pause and a cut. Our view was that it should be a pause, which is what came through. And I'm just going to correct you. The decision to keep the stance neutral was not unanimous. In fact, 2 of the MPC members voted to change it to accommodative, and that's one of the reasons that this is being seen as a very dovish pause. Now, if we look at why we thought a pause was appropriate right now is because while the inflation forecasts have been cut and we're at 2.6% as well in terms of the average for this year, the reason for the lower inflation is the policy change of the GST rationalization. It's not because of lower demand. In fact, the lower inflation is going to come with higher demand spurred by the GST rationalization. So that's why we thought that October was not an appropriate time to actually go in for a further rate cut. Now, looking ahead, I know I've heard some commentary that, does space open up for more than one rate cut? I really don't think so. We were at one rate cut and one more rate cut in August, which didn't come through. We thought this should be a pause, which has been a pause. And at best now, I think we can expect one more rate cut. Whether that comes in December or February remains to be seen. But certainly after the window for another cut is only December and February, right? Once we're in FY27 and we're looking at an average CPI inflation that's going to be above 4%, I don't see any more room for rate cuts coming in at that time, even if we have a GDP growth forecast which is in the mid 6s. So just backtracking, I mean, if we look at the scenario right now, we did get the higher than expected GDP growth in Q1, but as DG Gupta said, that's looking backwards, that's not looking forwards. My sense is that the GDP growth in Q2, my own forecast is quite a bit lower than what the MPC and the governor have said today. I don't think Q2 is going to be that great a quarter. 2 of the factors that really pushed up growth in Q1, one was government capex. And here, even though we got a good number in the month of August, the headroom which is left for the rest of the year is signaling a contraction. And in any case, the Q2 growth for government capex for Government of India will be much lower than the very high, optically high number that we got in Q1. Secondly, the impact of the US tariffs on the output and on exports is now starting to be seen. After a lot of front loading in Q1 through July, now we're starting to see those numbers coming off. And again, this is going to be a drag on growth going forward. And the third thing, which, time will tell, but I do think that there is going to be some pullback in production, basically from an inventory management point of view ahead of the GST rationalization. So the full impact on demand and on production will actually come in, you know, during the festive season and later. So again, Q2 from that point of view, I don't think is going to get too much of a benefit. Again, if I look at the direct tax data that we have so far on corporate taxes, that's also not signaling that this was such a great quarter. So I think, that's where I differ. H2, we are in line broadly with what the MPC has signaled on the growth side. So Q2, I think, is going to be lower. So I'm still sticking to a 6.5% growth forecast for FY26.
6.5% growth forecast for FY26, lower than what the MPC has estimated. Let me come to you, Mr. Sabnavis, as well. What stood out for you in the policy announcements, and no rate cut at least this time? Is it a sign of relief for all the banks on the margins front at least, sir?
Yeah, from a point of view of the banks, I think this is a relief. But I think what really stood out in this particular policy is the fact that the governor did mention that there is room for, or rather there is scope for actually supporting the economy, which actually indicates that even though the stance has not been changed, there is a possibility of a rate cut sometime ahead. So personally, I feel that it may be a bit difficult. Maybe the conditions have to be quite extreme to get in this particular cut. The reason being that the governor has been reiterating once too often that credit policy has to be forward-looking, which means that when you're looking at Q1 inflation of 4.5% next year, I mean, it's been revised from 4.9 to 4.5%. At 5.5%, we'll have a real interest rate of 1%, which is actually below the thumb rule which exists. This thumb rule, of course, is something which came from nowhere. It's not something which the RBI has expressed, but some of the studies actually show that the real rate should be in the region of 1.5, 1.9%. So considering that we're at 1%, it would be a bit difficult to cut rates. We should just remember that inflation next year will definitely may not be that benign, 2.6% this year. It's going to be something above 4%, maybe closer to 5%, in which case you will have to start increasing rates. So therefore, I don't think the RBI would actually like to get into this position unless there is something which is extreme, which happens maybe on account of the tariffs. The impact appears to be worse than what we have expected. I think that could be the only factor which could be driving the interest rates down. So as of now, we go along with it that there could be one more rate cut, 25 basis points, and that would be the end of it. Though personally, I felt that 5.5 was the end of it in June, but it looks like that since the RBI has stated that there is room to support the economy, we could probably look at another rate cut during the course of the year.
So what is the likelihood? December possibility or a February possibility? What are you looking at?
No, actually, it could be either of those two possibilities. I don't think it's easy for one to say when it would happen, if at all it happens. But we always felt that October it could be ruled out. Maybe December depends upon how the inflation number really looks, because we're all aware of the fact that we have had these flooding conditions in the north and also parts of west and southern India, and we really don't know what's really going to happen to inflation. In case food prices do start increasing, the RBI may probably hold on for some more time. Similarly, when you're talking in terms of the the tariff impact, we'll have to wait and see as to at what point of time it actually strikes us, and we really see that the economy is slowing down. That would probably be the trigger point. So it could be either December or February. If you're forcing me to give an answer, I would probably say December.
December. Okay. Yes, because the last one that we had was in June. We, like Aditi also pointed out, we were hoping that August would happen, but that didn't come through. Aditi, would you also pencil in? You just said that, not more than one rate cut. So December possibility and a 25 basis points is what you're penciling in again?
So no more than 25 basis points.
No more
Feb, I think from an inflation point of view in terms of the forward-looking trajectory is much more complicated than December. In December, just before the policy meeting, we will get the Q2 GDP number, which I was talking about earlier. If it's as high as 7%, then, again, it becomes difficult to cut in December. But if it's more in line with what I think, which is sub 6.5, then maybe there could be space to cut in December, especially if the broader noise in terms of tariffs, etc., is more unsettling than what things look like right now.
Okay. Mr. Sabnavis, 6.8% of a forecast for FY26. Do you also believe it's a little on the higher side, more ambitious given the tariff risks that we have?
So actually, we'll have to get back to our Excel sheets and see how we had a number of 6.5%. And we said 6.5% with an upside. Now 6.8% actually aligns with what the government had projected in the economic survey, 6.3 to 6.8 on the upper side. So I think 6.8, but I really don't think it matters much whether it's 6.6 or 6.8. The fact that we're above 6.5% is important, because I think with tariffs, there was always this fear that we would slide below 6.5%. So the comfort now is that based on all these base effects, as well as the tariffs, etc., if you're still doing something above 6.5%, it's very good.
Okay. Aditi, on inflation, do you see more upside risk than downside positive move on inflation and the forecast that we have at this point in time? Again, because of the risks that you pointed out already, how do you see the inflation forecast?
So just, for on growth, just a minute. Basically, we started the year forecasting FY26 GDP growth at 6.5%. Because of the tariff-related issues, we brought it down in two tranches to 6%, and with GST, we brought it back to 6.5%. So in a sense, we're back where we started. The big in all of this, in my opinion, is private capex, which for this and a number of other reasons, sentiment on capex is not improving. Even though I feel that GST has improved general business sentiment, people are more hopeful than what they were earlier. But I don't think even now people are really ready to start investing, and that is something that becomes a net negative, which is lingering through this year. Now, on the inflation side, I think 2.6% is a very fair estimate at this point for FY26 CPI inflation. I don't think I would, take either skew in terms of the risks. I think it's quite evenly balanced. The monsoon has broadly been good, notwithstanding the flooding that we had recently. And looking ahead, the reservoir levels are going to give us quite a lot of insurance in terms of, how the outlook for the next couple of crop seasons pans out.
Mr. Sabnavis, on something that Aditi did mark out for us, how are you really looking at the aspect on that front as well? And would you also like to add on the inflation bit a little bit?
Yeah, I think there could be an upside to inflation. I think 2.6 is definitely on the lower side, because our estimate is that because of the flooding which has taken place and the crops which could get affected, we're looking potentially at something happening to the pulses segment as well as oilseeds. And edible oil prices are anyway high in the market today. There's probably an upside. But again, I would say whether it's 2.6 or 2.8, where that's what we would like to believe, it will be around 2.8%. Doesn't really matter. As long as you're less than 3%, psychologically inflation is low. And the base effects are definitely going to play out very well in the next quarter or so. So it's only in the fourth quarter that we're talking of numbers of 4%, which is probably increasing to beyond 4% in the first quarter of next year. So therefore, I think inflation largely seems to be a number well under control. So I think it's just a subjective view of the MPC as to how you should look at it when it comes to considering whether it's low enough to trigger an interest rate cut, or look at it in a forward-looking manner, saying that okay, it may be low today, but it's going to go up because of the base effects to tomorrow, and therefore let's hold back on the rate cut. So it's essentially, as I told you, it doesn't really matter whether it's 2.6 or 2.8, as long as you're below 3. In fact, as long as you're below 4, I think that will give a lot of comfort to the MPC.
Understood. Aditi, just to extend your point on private capex as well, the government has probably done everything that they could on the taxation front to boost the demand. We have had indirect and direct taxation benefits. Overhauling of the income tax bill as well has been done and dusted. MPC has been front loading the cuts as well. Despite that, we haven't seen this private capex pick up pace. What do you think is still preventing? Is it only the external shocks and the uncertainties that have been shrouding us, or are you penciling in some more factors to it?
See, if we look at it over the last few years post-COVID, we've had one reason or another that has kept the sentiment on private capex dull, despite the fact that your capacity utilization is averaging that sort of what used to be a magical 75% number previously. At some point, rural demand was a problem, then urban demand was a problem. Now there is this complete uncertainty on tariffs and on the external side. And you really can't blame producers for not really wanting to get into a higher capex at this point in time. And the government has done a lot. I think policy overall has been very supportive. We've got income tax cuts, we've got GST cuts, we've got 100 basis points of rate cuts, we've got a good monsoon. Everything else that usually you would want to be in place has been in place. So it's not as if there has been any lack of support. There have been so many other schemes also, PLI, etc., that the government has brought out. I think it will take some more time. There will really have to be a clear visibility on our domestic demand, and then maybe private capex will come back in a bigger way. So I'm not saying that private capex hasn't happened at all. It has happened, but in a piecemeal fashion. So the narrative just doesn't build up of a big capex cycle. And also there have been sectors like new age sectors, etc., where we have seen capex happening, but somehow the overall theme and size doesn't feel one that is large enough for it to be called a private capex boom.
Okay. Mr. Sabnavis, would you like to add to it? For the RBI at this point in time, what do you believe is more important to track at this point? Both the growth and the inflation is perhaps moving in tandem, in sync with what the RBI would have wanted it to. At the same time, the external shocks, they continue to, cast an overshadow here. How would you look at what is most important for the RBI to keep a tab on at this point?
See, the RBI was rather the MPC was initially asked to target inflation. Subsequently, we have added the dimension of growth. The growth was also mentioned, but it was kind of a secondary objective. So I think the metrics which we're dealing with is growth and inflation. So these are the two parameters which the RBI keeps looking at all the time. And then, of course, you'll have to gauge what's the domestic environment and what's the external environment to actually get a hold of what are the prospects for both growth and inflation. So that's what the RBI has been doing. Now, on this issue of a private investment, I just have a view. If you don't mind, I could just express it out here. But see, what we have seen in private investment is that it's definitely not broad-based. Second, I think a private sector invests only when there's a return on capital. See, unlike the government, which invests because it has to invest. So when you have 11 lakh crores of capex of the government of India, it will happen because it has to happen. Whereas when you're looking at a private sector, unless you have enough demand and you're able to generate a return and justify it to the shareholders, you're not going to invest. So while the private companies always keep saying that we are going to invest, we're going to invest, they will never invest unless they see that demand. And today, I think the GST, what it's actually brought is that this revival in consumption, it could be a trigger point for the backward linkages to set in as far as private investment is concerned. Currently, it's more infrastructure based.
Okay. Aditi, could you also help us understand, your view on the bond market as well as to, we've seen the stock markets definitely give a thumbs up, especially the banking counters, with of course, RBI proposing a series of measures to also increase and improve the credit flow and ease of costs and expand the lending flexibility at that. Bond markets, how are you looking at that?
One point on the inflation expectations that I didn't cover earlier. Possibly this time, if the GST rationalization actually goes through seamlessly in lower prices, hopefully the consumer will be able to see it and believe it. Often what happens is that when you are sitting on a very high base and that's bringing inflation down optically, the consumer doesn't feel that. They're still looking at prices being high as per months. They're not sitting and calculating that, oh, last year, tomato prices or onion prices had gone through the roof and therefore I should be feeling better about my household budget. And therefore, that dichotomy comes in between what the official numbers tell us for the inflation versus what people feel their inflationary expectations are. I think in this cycle, I'm hopeful that with the GST rationalization, for a larger number of people, it will be more apparent that the prices that they face have come down. And therefore, that add to the feel good factor in terms of channelizing those savings to maybe buying either upgrading in terms of getting a car with more features or getting household items that are at a higher price point, with more, premiumization, or just going out and spending the savings on discretionary services, for instance. So I do hope that it's going to bring in feel good and overall bring in some buoyancy, given the fact that the tariff situation is going to potentially lead to weak sentiment in sectors where job losses are feared.
Yeah. Okay. Mr. Sabnavis, if you could also help us understand, how are you looking at the RBI proposals on these series of measures to improve the bank's credit flow and to ease their costs and probably to expand their lending flexibility? A series of measures have been announced there. What stood out for you here, and how is it likely to impact the banking space, sir?
Yeah, actually, if we're looking at things like the ECL, for example, that was something which was already on the cards. I think that there has been a definite roadmap which has been provided, which provides more clarity to banks. But I think most banks have already been prepared for it, because it's not that it's come out of the blue. But what I saw as fairly significant is when they're talking of financing of acquisitions. So I think this is a significant piece, because so far banks have not been allowed to finance such acquisitions. And we have seen that this M&A activity has been fairly rampant in the Indian context. So I think this is a new opportunity which opens. Again, if you look at the internationalization of the rupee and giving certain scope for Indian banks to start lending in rupees in countries like Lanka, Bhutan, and Nepal, may not be a big business, but yes, it's a positive thing. And for lots of banks which have their offices in other countries, once you're able to show that it works in these smaller geographies, we can actually think of such kind of lending activities in other geographies too. So I think on the whole, I think there is definitely some kind of positive sentiment which has been developed out here, especially for the banking system. Even in case you're looking at the large exposure norms which came in 2016, now that that's been withdrawn, it's going to be more on event basis where there will be regulation coming in. I think all this opens the door for larger banking activity. And this also goes along with the fact that what we really thought would happen in the corporate bond market may probably not have really materialized the way it was conceived earlier. So therefore, I think they're giving more elbow room to banks to operate in this particular space.
Fair point. I'll come to both of you for the closing comments there to have all our viewers pencil it all down. Both of you have marked out one more rate cut. Mr. Sabnavis believes that it could be December rather than February. And Aditi also believes like one more rate cut, not more than 25 basis points is what we are given to understand. And that also hinges a lot upon what happens on the growth factor as well. Aditi, your GDP and your inflation forecast for FY26 and for FY27 as well.
So FY26 GDP 6.5%, inflation 2.6%. FY27 GDP wide range, anywhere between 6 and 7%, depending on how different policies pan out, especially how the tariff situation evolves for services, and CPI inflation in the range of 4 to 4.5%.
Okay, Mr. Sabnavis, to you.
Yeah, see, we had a GDP forecast of 6.5 with an upside. I think we'll have to rework those numbers, but I think it will probably go up to 6.6, 6.7. Inflation, our sense was it will come something close to 2.8% for the year. For next year, we're still looking at GDP growth 6.5 to 7%, because I think the worst of the tariffs will be behind us. And it'll actually be a case of growth going into the higher mode. Inflation, to my mind, will remain in the 4.5 to 5% range, because if you look at it, traditionally, India has been a 4.5 to 5% inflation country. Anything less than that has been more a case of chance. So I don't really bet on inflation remaining at low levels for a very long period of time. But just one thing I'd like to bring to your attention is that while we are all quite happy about what the RBI has done, but if you look at the bond market, the 10-year yield, to my mind, hasn't really moved. It still remains at 6.60. So the market doesn't seem to be too much enthused. Maybe the market is not looking at another rate cut. Maybe they were looking at some definite steps to be taken for on liquidity, whereas the RBI has said that the CRR is still to work out, and it's banking on the earlier measures which it's taken. But a bond market definitely has been fairly impervious to this particular policy.
Absolutely, we'll note that as well. Thank you so much, Mr. Sabnavis, and thank you so much, Aditi, for being with us again, explaining to all our wider audiences as to what the decisions and the announcements mean. Of course, so giving us a outlook as well as to what do we expect on both growth as well as inflation front going forward, as well as on the EMIs that are likely to get slightly more reduced with that one more expected rate cut going forward. Thank you so much for being with us on the show. All right, viewers, we'll wrap it up on that note. Do stay tuned with us. Much more coming up on your screens on the other side, beyond the RBI policy, decoding that, and of course, the market moves.